Hi, Jean-Marc here over at Financial Attunement. Thanks for joining me. I wanted to cover today one of the most basic principles in understanding where and when to invest in real estate. Many of us turn to real estate to expand our passive cash flow, with the ultimate goal of having that cash flow exceed our monthly bills, giving us financial freedom. But on the way, many of us stumble, make mistakes. Understanding how to read a market and understanding where and when to invest is absolutely key to avoiding those stumbles. So that's what I want to cover today. For those of you who don't know me, I'm a San Francisco-based real estate investor and mortgage broker with a background in engineering and contracting. Over the past 30 years, I've bought, sold, built, traded, repositioned, and mostly financed thousands of properties. My passion for real estate started early. Back in 1982, I wanted to buy a single-family house, but I couldn't afford the mortgage. I looked at an in-law and the numbers seemed to work better, and I quickly figured out that as I bought more units, the numbers looked even better, and ended up buying a sixplex. It was vacant and in foreclosure, so I quit my engineering job and rehabbed it, doing most of the work myself. And once I rented out the place and refinanced it, the interest rate dropped from 18.75% to 12.5%. Woo! I was ecstatic. I took out a bunch of cash and decided I was not going back to my job. A few years and several projects later, I bought a 15-unit building, still in San Francisco. This again was a distressed property that I fixed and ran for a while before selling. But this time something different happened. I lost my shirt. I had done everything the same, but better, as I gained experience and efficiency. But the timing of the overall market changed everything. I had missed a basic principle in business, the market cycle. Oh, I had studied it in school, knew what it was, but how did that affect little old me? A little building in a big city? It didn't apply, right? I took a beating for ignoring that tenet, and that's why I wanted to focus today on the market cycle. Imagine continuously buying at the bottom of the market, selling as it nears the top, and starting over. How cool would that be? You make all the profits on the way up and incur none of the losses on the way down. Actually, it's pretty simple to do once you understand the principles. So, let's take a tour of the magical market cycle. We start over here in the correction phase that we call Buyer's Market 1. Dominant characteristic here is the oversupply of properties. The market's overbuilt and both buyers and sellers know it. Demand, rent, and prices are all falling. Time on the market increases sharply, and there's no speculation, with pretty much all construction stopped. Unemployment is highest, and foreclosures rise, with some owners just walking away. This is the bottom falling out of the market, and you have no idea where the bottom is. So you just kind of have to sit tight and stay on the sideline. Does this sound familiar? Many areas in the U.S. and beyond have just gone through this. But the cycle will turn. It always does. And with a little knowledge, you'll know how to read the signs and know exactly when it's going to be turning the corner. Rents and prices stabilize in what we call Buyer's Market Phase 2. Time on the market decreases and the oversupply is absorbed. Foreclosures decline and the competition to buy them is fierce. Job growth starts to increase, often as a result of government incentives. Then the multiplier effect comes in. As businesses relocate to the area, every job they add brings in 3 to 4 additional jobs in the service sector to support the original ones. And the upward cycle begins. The strategy here is to buy everything you can get your hands on. This is the millionaire maker stage. As demand and prices rise, the buyer's market transitions to a seller's market, Phase 1. The supply of property dwindles and properties are selling faster. Foreclosures are rare and unemployment drops. Prices and rents continue to rise. After long periods of inactivity, speculation and development are in full swing, with existing properties being rehabbed and construction starts accelerating. In buying at this stage, you've entered the market half past the optimum time for long-term appreciation, but there's still plenty of money to be made here, as no one knows how long or how far the market is going to increase. The strategy here
is to buy and hold until you see the market slowing, or just fix and flip. As prices continue their rise, owners will start to cash out their accumulated equity and start selling. Add booming development and construction, and you get a rising supply. At first, demand remains strong and the excess supply is not enough to shift the market. But eventually, it'll tip from the seller's market stage 2 into a buyer's market. Time on the market increases, though sellers are still getting inflated prices. Investment properties and land are bought in speculation, not cash flow. Rents become stagnant, and business and jobs begin to slow. Strategy here: get out fast. Over the past 50 years, we've had 4 complete boom-bust cycles in the national real estate market. Real estate is predictably cyclical. A boom will eventually bust, and doldrums will eventually turn back to prosperity. But the entire U.S. does not move at the same time. Each community has their own cycle, and those cycles are driven by what happens locally. One area can be booming, while the other is doing the opposite. Taking a quick glance across the U.S., we see markets doing different things at different times. As your own market might take years to be just ripe to invest in, you want to look at what part of the country is ripe now, and constantly reevaluate each of the markets you are invested in. Look for areas with rapid labor and population growth. Think of emerging markets like Phoenix, where Sun Microsystem brought 20,000 jobs there in the 90s, and markets rose 42% over the next 3 years. Or the Dallas Metroplex that added 120,000 jobs from 2005 to 2008. That market rose 46%. These very quick 3 to 4 year job spurts are prime targets.
So, by focusing on these areas, the market itself puts upward pressure on the rents and occupancy. So any property you buy is going to be helped by this rising tide. So studying the markets, understanding when the slide is ending and when a long rise is ending, is absolutely key to knowing when to get in and when to get out. If you don't understand this, you're flying blind. And if you do, you have the secret sauce to success. You make all the profits on the way up and none of the losses on the way down. Are you with me? Cool. So, now is the time. Many of the markets have just turned the corner. There are many, many markets. Typically there are 10 to maybe 15 emerging markets across the U.S. Now there are 40 plus, more than that. There are so many opportunities right now. Now is the time to take action. So, join me in my next video where I share with you our particular niche in the markets. And I'm not going to tell you. Come to the video. And or click on the links below and sign up for our blog. We'll send you markets information, we'll send you valuable information and tips on investing in real estate. Join our community. Tell us what you think. Join us. I look forward to seeing you there. Talk to you soon. Bye.